Okay, we are live. Welcome, everybody, to episode 85 of the Volatility Barometer podcast. So if you are new here, I have noticed that we've got a few new subscribers in the last month. I have been putting out more content, so I think it's attracted a few more of the volatility traders out there. So you're probably used to sending super chats to ask your questions. My live streams are always free, so don't use that function. Just don't send any money. You can start populating your questions in the chat now. We will get to those in a little while. But the payment for the live streams, unfortunately, I have no way of enforcing this rule, but I would very much appreciate if you give the video a like for me. It pushes it out to the YouTube algorithm. It's very, very helpful for spreading the videos to my relatively small audience, but hopefully a little bit larger audience as we get going. So, all right, got to take a deep breath. I did that thing that I've told myself I would not do. I just had a feeling that I wanted to go running a few hours ago. So I got on my shoes, and unfortunately, the live stream today is a little bit earlier. So unfortunately, I had to go while it was still daylight out. It was still sunny. Dubai, 38 degrees, sunny, hot, pretty humid. A lot of people think it's really dry here. It's actually not. It's quite hot and humid. And so I barely made it back again. Ran my 15 kilometers, but got to say I'm a little bit tired. So if I look like it, well, that's the reason. But I'm a professional, so here we go. We are going to do this. So like I said, get your questions in the chat. We're going to answer those. We're going to do two segments today. The second segment isn't super important. So if I've got a lot of time left over, then I'm just going to rip through that in about 5 minutes, but we could skip that one. But it's mainly that first one. I had a very interesting question, and it's something that I get a fair bit, to be honest. And I thought, well, this is going to make a good live stream. Let's just unpack the whole thing, talking about beta slippage and leveraged volatility ETFs and all that stuff. So again, please hit the like button for me. It's really the only payment that I can require here. And let's get started. So this subject today about beta slippage essentially came to me with a very common question that I get. So this is our email from yesterday. This is Friday, but here's our portfolio. And what people sometimes ask me is if we can switch out the ETFs and start using some of the leveraged ones. Now, I don't specifically mean adding more leverage. What I mean is, you can see this strategy, tactical volatility. We are in the SVXY. Whenever the market is calm and stable, we're going to be profiting from the short volatility trade, and we use SVXY. This is a minus 0.5 times product. So the question that I get sometimes is, well, why don't I take a half allocation in something like the SVIX, which is a minus 1 times? It's essentially double the leverage of this one. So if you were to do that, you were to take a half allocation of the SVIX, you could free up 50% of your capital that's dedicated to this strategy. And then you could put that capital in something like the SHV, which is a short-term fixed income ETF that pays about 5% a year. If we go down here, defensive rotation, same thing. Today, I'm going to assume that we're talking about people who are actually using the 1 times QQQ. I like to use the 2 times Qs because when the market is stable, it's relatively predictable in those lower ranges, but we're just going to assume today that a person uses the QQQ. Well, in this case, the person could buy a 1/3 allocation to something like the 3 times leveraged TQQQ. And again, now you've got 2/3 of your capital of this 25% that you could dump into a 5% fixed income ETF. And the strategic tail risk, the same thing. Instead of the SPY, which is a 1 times ETF, you could use the UPRO, for example, which is a 3 times leverage, a 1/3 allocation of the 3 times leverage. So essentially, you understand what the person is getting at, that if you were to do this throughout the portfolio, you could actually free up a significant amount of capital, and then you could dump that cash into something that might make you an extra 5% a year. And wouldn't this be a better, more efficient use of capital? So this is a fantastic question. Of course, I run the numbers on everything. I've been doing this for many, many years now, but I'm going to share the results. And the main reason that you want to watch out for with leveraged ETFs of really any kind is what's called beta slippage. So let's get into that. Essentially what we are talking about, you might actually see this referred to as beta decay. You might see it as beta drag. You might see volatility drag. It's all the same thing. It's explaining the same process. Essentially what we are talking about is beta slippage is a multi-day price tracking inefficiency that is present in the leveraged ETFs caused by the mandated daily rebalancing. So that's how the ETFs work. At the end of the day, they rebalance back to their desired leverage factor. So if it's a 3 times fund, it'll deviate throughout that day because it's just a 1 daily tracking. And then at the end of the day, they will realign the fund and start the next day with the desired leverage factor. What this actually has an implication for it. So leveraged ETFs are designed to track exposure on a daily basis, but over time, the performance will deviate from the multiplicative defined daily ratio. And I will get into what that means. But essentially, this is what we're talking about with beta slippage. Now, it's always easier to learn through example. So we're going to run through a whole bunch here. The top section, we're going to do equity ETFs, and I'm going to use the Qs, the underlying NASDAQ, as the example. So you could use the SPY, you could use anything really. I mean, there's leveraged ETFs these days for pretty much everything. We're going to use the NASDAQ in this case. And then at the bottom here, you can see we're also going to run through all of the volatility specific ETFs. Again, our community is pretty volatility specific, so that'll be interesting to you. But essentially what's happening here, we are going to start at $100 for all of these examples. And we're just going to run through something that goes up 10% and then down minus 9.091% the next day. And then up 10, down 9.091 the next day. So a 4-day run, we're going to see what the final return is. And the reason that I'm not doing up 10 minus 10, remember, just with geometrically compounding returns, you've got this ever diminishing return if you're going on the negative side. If you're going on the positive side, if you have a 10% drawdown, you actually require an 11% subsequent rate of return to get back to break even. This is essentially what we're talking about. Losses are more costly than gains are beneficial. And whenever you have a running sequence of compounded returns, there is going to be an inefficiency there. That's really what we're getting at here. So if we go through the first example, this is the 1 times Qs. And this we could call the baseline. There is no beta slippage in this example. It is just 1 times the NASDAQ. So you can see if it's up 10%, 100 to 110, it drops back down right where it started, back to 100, up to 110, back to 100, and there's no loss of capital over time. All right, there's no beta slippage for this baseline 1 times ETF. But if you go to the 2 times NASDAQ ETF, we would expect that this is where that beta slippage starts to happen. Now that you can see the reason it's happening, if you go 100 times 10%, you're now at 120 because you have to do 2 times 10%. This is a 2 times leveraged product. So it actually goes up 20% the first day. And then the second day, it doesn't go down 9.091, it actually goes down 18.18. And if you're starting with a high number and then you have a drawdown, again, we're talking about geometrically compounded returns here. What ends up happening is you don't quite get back to that 100, right? You're down a little bit of capital. Now, I will say, obviously, it's very unlikely that you're going to get a run in the market where you're talking about up 10, down 9, up 10, down 9. I'm just doing that to amplify it so you can see it over 4 days. Regular beta slippage, we're typically talking about, the 1, 2, 3% range. It will take several weeks to start to notice these larger numbers, maybe a month or two, but it is present, and this is just going to illustrate the example. So again, another good day here on day 3, drops back down, but you can see it actually lost money. This is beta slippage. That is volatility drag. And essentially, it gets exponentially worse the more inconsistent the results are going to be. So beta slippage is not some type of static thing that we can predict and calculate ahead of time. Essentially, if you were to imagine, if you're talking about a up, down, up 1%, down 0.5, up 2%, down 2%, something reasonably consistent, the beta slippage in that case might be a little bit more consistent. If you're talking about something that's, let's say it's a really rocky period in the market, up 5%, down 6, up 7, down 7, that can happen during those really rocky periods. You're talking about much larger beta slippage. Now, the one thing I also have to mention here is it's not always negative. If you were to imagine a period of time, of course, it's going to be a shorter period of time because it requires less losses, but beta slippage can actually work in the favor of the long products. Let's say you had, in 1 month, there's 21 trading days. Let's say 18 of those days were positive and 3 of them were negative, but just barely negative. You could actually see that the leveraged funds significantly outperform what you would expect based on that leverage factor. So the 2 times leverage fund after the end of the month, it might make more than 2 times the underlying. But typically the situation we're talking about, because the market actually does have ups and downs, typically beta slippage is considered a negative thing. But just keep it in your head that sometimes beta slippage is actually the other way. It's actually positive. So you can see this one lost money. Here's the next one, 3 times leverage. Now it's up 30% in 1 day, so off to the races. This is why people love leverage products. You can make more money. But again, it's not dropping 9, it's dropping 27.27% in 1 day. And because of the inefficiencies and the way that exponential leverage works, this is going to take the fund down significantly. So you can see at the end of the 4-day run, this one dropped quite a bit. So this is an illustration of beta slippage. The more leverage you have and the more rocky the returns are, basically larger numbers up and down, you're going to get significant beta decay. Now, this one is quite interesting. This is one thing that a lot of people don't know. You'd think, well, okay, -1 times the NASDAQ. This one should also be the baseline, right? This one should be just like the 1 times NASDAQ, just the other way. But that's not actually the case. If you look at it mathematically, what ends up happening is the -1 times NASDAQ is a daily rebalanced leveraged ETF. That -1 times leverage is an inefficiency that will show up mathematically. So actually -1 times leverage is the same beta slippage as 2 times long the leverage. This is something that, again, I will point out when we get to the volatility products down there. But you can see significant beta slippage on just a -1 times product because it has to daily rebalance. It's going to lose a little bit of ground there. Again, it's dropping 10, it's gaining 9, dropping 10, gaining 9, but it's opposite. So I guess it would be drop 10, gain 9. It's not going to get back to break even. That's why it's happening. The 2 times, as you can expect, it's going to be significant, and it's actually going to be more than the 2 times long because, again, -2 is a significantly leveraged position. You can see -7 compared to 3. It's double the beta slippage. And then the 3 times negative, this is really bad. So this is why a lot of people try to do the old, what if we were to short both of them, short the TQQQ and short the SQQQ at the same time and run that forward? I get so many questions on that. I think what I'm going to do is maybe in a live stream or two, we have to wait until the right timing. I've tested these strategies so I know when to enter them. But I think I might just keep a running trade open and just have it there to show people how that behaves when you short both the 3 times up and the 3 times down at the same time. I think that might be interesting for our live streams. But the basic point is, yes, it can get quite diabolical when you're talking about -3 times NASDAQ. Again, we're not expecting up 10, down 10, but beta slippage over a few weeks or a few months can be significant. So let's talk about volatility products. Now, the 1 times VXX, this is the new baseline. And I marked these in red because, of course, they are inverse correlated to the market. So when the stock market goes up, the VXX goes down, and vice versa. When stocks go down, typically the VXX is going up. But this is still the baseline strategy. There is no beta slippage on the VXX because it is just 1 times long, right? There's no inefficiency on that daily rebalancing. But the UVXY at 1.5 times leverage, yes, there's going to be some slippage there. Not a lot. 1.5 isn't like up here going to 2, but 1.5 is significant enough that there's going to be a drag there. 2 times, as you can imagine, it's down 3.6. The thing to notice here, again, it's worth noting, this is not happening because of the underlying security. It's not happening because the UVIX itself is some type of volatility-related product, and that's why it's going down. It's because volatility products specifically are designed to go down, people say. That's not it. It's actually just a pure mathematical principle that we're talking about here. It is quite literally just beta slippage based on the leverage. So the 2 times long UVIX has the exact same beta slippage as the 2 times long NASDAQ. Remember, it's not the underlying security that's doing it. Any 2 times is going to be the same as any other 2 times. Now again, -1 times the SVIX, Many people think there isn't any, but of course, -1 times is a leveraged ETF. It is a daily rebalanced ETF, and there will be the same slippage here as there is with a 2 times long UVIX. So people think that, it should be half. It's not. That's actually the same mathematical slippage. Then you're talking about the SVXY. This is a product that I personally use because I happen to like the fact that it moves up and down a little bit slower, and we can manage those drawdowns a little bit better. And again, it's going to be beta slippage, but not as much. So interesting to note, the SVXY at -0.5 is the same beta slippage as the 1.5 UVXY on the other side. So you can see why it's happening. Essentially, there's just inefficiencies when you're compounding returns over time, as investment results do. This is not arithmetic compounding, it's geometric. And of course, there's going to be some inefficiencies at the end of the day. They have to rebalance. They have to bring the fund back into line so they can start the next day at exactly 0.5, exactly 2, 1.5, all the way through. That's essentially what is happening. Now, to answer that question specifically about is it a good idea to do this, because remember, there's 2 things that are offsetting here. The first thing is the beta slippage. If you do 1 times the Qs versus a 1/3 allocation of 3 times the TQQQ, there will be some inefficiency there. There's beta slippage. So on the surface, you might say, well, that's not worth it. Of course, the 1 times is better. But you got to remember that there is a 5% fixed income ETF that comes into play here with that idle capital. So the question is, which one of these effects is bigger? Now, fortunately, with our work at VTS, I am, at least for these 3 strategies, our options are discretionary to some level, but our 3 tactical strategies are entirely systematic. So we are just using volatility metrics to filter out the noise, and we're determining when we're going to be in the NASDAQ, moving to safety, moving to cash, moving to low bonds. We can do this. So what I can actually do is I can take this QLD and I can stick any stock or ETF in there, and I can just show you exactly what it would have performed going all the way back to 2012. And I can make these comparisons. So I guess it's not the reason I do tactical investing, but it is a nice little side note that if there's any question, gee, I wonder how such and such would have done in the same position. Well, give me 10 minutes, I can give you that answer. And what we can do is use the 1 times baseline Qs. So I can show you this is what would have happened in that strategy had the person used 1 times Qs instead of 2 times the NASDAQ. So still really great performance, right? Now the question is, what about using a 1/3 allocation of a 3 times TQQQ? You can see the red line is lower. You can see 290 to 250. That's about a 14% performance drop. That's due to the beta slippage. Now we have to focus on the fact that my signals are pretty accurate, right? We don't get it right all the time. There is drawdowns, of course. We have false signals. We have drawdowns. Every strategy does. But we are only going long the NASDAQ when we get the best signals. If it was buy and hold, the beta slippage disaster would be far more significant, because remember I said the more inconsistent the results are, the more beta slippage you will see. So in this case, the reason that it's only a 14% difference is because I'm pretty good at knowing when to be in the stock market and when to be in safety. But this is actually significant. Now, the real question is, what happens if we add in a 2/3 allocation of the fixed income ETF called SHV? That's the green line. And you can see here, it does, of course, recover some of the losses, but it's not enough to get back to what the 1 times standard Qs is doing. So the long answer, all of this presentation, hopefully it's important. Hopefully people are learning something. I prepare these live streams. I think, oh, the community is going to think this is really cool. I'll share some data. So give me a thumbs up if you're liking this stuff so far. But throughout all of that, the general conclusion is that no, it is not worth it to do that. It is still better off to just avoid all the complexity and go ahead and just do the 1 times Qs. And in our case, or in my case, and I would imagine most of the VTS community, nothing wrong with adding a little bit of leverage here, because again, we're going to be cycling into safety. And there was one drawdown period in the past where, obviously it wasn't very comfortable during, say, the 2022, where every asset class was down, including utilities, I mean, what are we supposed to do, right? We moved to safety, and safety itself also went down just as much as the stock market. So, oops, not much you can do there. But for the most part, just stick with the 1 times Qs or the 2 times QLD, and that's the deal. But if you want to see, there's a slight variation that I should point out with respect to the tactical volatility. This is a little bit different. In this case, we're using the SVXY, which is a minus 0.5 times leveraged product. So again, what would happen if a person instead of this used a half allocation of the SVIX instead? This is totally systematic. I can plug any ETF in here I want. Here is the baseline SVXY. Now, one thing you might notice here with this chart, it only goes back to 2022. This is actually a rolling 2-year chart. Now, the reason that I'm using a 2-year chart, this is getting a little more geeky in explanation, but bear with me here. Remember that the volatility ETFs track underlying indexes, right? It's not a supply and demand issue. It's not because a whole bunch of people are buying or selling the SVXY. It is tracking an underlying index. The underlying index for SVXY is called the SPVXMPIT index, right? It's long letters, whatever. The underlying index for the SVIX is called short vol. Now, the short vol index and the SP index are not exactly the same. And going back in time, the short vol index is significantly better at tracking basically the indicative value of the ETF. Now, since the Volpocalypse event in February 2018, they made a whole bunch of changes to all of these underlying indexes. They basically, it's a long list of things. I actually did a live stream about it here. I can just point it out that some of my past work, if you go back through these live streams, some of them are actually really, really good information still. Of course, it's my live stream and I'm saying that. But this one here that says new vol ETPs, in this one, I explained the difference between all of the underlying indexes. So you might actually find that one quite interesting. But they did simple things like they took the rebalancing from 4:15 to 4 o'clock. They reduced the spread on the trade at settlement market. That does a little bit. They increased the rebalancing window a little bit from basically instantaneous to something a little longer. And long story short, the new indexes, the short vol and the long vol, are now very, very close to the underlying SPVX, SPIT, the STR, all of the MP5I, all of these indexes have actually changed and they're quite good these days. So I decided to only show the 2 years because of course that's really only relevant. Now, here is the comparison between the half allocation of SVIX. You can see it is also bleeding quite a bit due to the beta slippage. This is again 14% difference, but here it's only 2 years. This one is happening over 12 years. The beta slippage here is over 2 years. This illustrates 2 main points why the beta slippage here is bigger. Number one, like I said, the more inconsistent the results are, the more it's actually going to show up. So there's going to be more here because, of course, volatility ETPs, they do actually move a little bit more up and down, even based on the same leverage factor. And then the second reason, if you go into my volatility dashboard, this is in every daily email, we can see the beta to the S&P for the SVXY is actually over 1. It's 1.36. Beta is a measure that basically compares the movement of one security in relation to another. So this is the movement of SVXY compared to the movement of the S&P 500, and it is leveraged. Even though this is 0.5, it actually moves more than the stock market. So those two things together are combining for additional decay, 14% over just 2 years. But again, we've got that SHV allocation. We can recover a little bit of that money, but it is not enough to recover to get whole again. So bottom line is, for anybody who's thinking about doing that, first of all, now you know what beta slippage is. You can totally understand. Sometimes it might seem like, wow, there's an opportunity to do this with this one, and don't forget that. And don't forget as well, this is included in the NAV value, of course, so you don't have to calculate all this, but just remember that the expense ratios for the TQQQ, they're significantly more. The expense ratio for the S&P 500 is 0.09, where the UPRO, for example, is over 0.9. So it's 10 times the expense ratio. Again, that's included in the NAV, so you don't have to back that out. But yeah, The beta slippage alone probably nullifies all of these little strategies that people have in their head. And then, of course, when you're shorting things, you have to add the short fees, you have to add trade fees, you have to add the fact that you're not in control of your own shares. There's a lot of additional layers to consider. It's not just a pure, straight mathematical, let's just do this one versus this one, and I should pick up that arbitrage in the middle. It really never works out that way. But like I said, what I can do is keep a running trade going, and it'll be much easier to illustrate why these things don't really work so well when we've got live trades on. So that'll be pretty cool. Okay, so how long did that take? 25 minutes. That was a little long, so I think what I'm going to do is leave it there. And all the Iron Condor stuff, of course, we can always just do another live stream next week, and I can just tack that on. It wouldn't take very long, but yeah, let's see how many questions there are. And there's quite a few questions. I should call it. So, yep, there it is. That's the beta slippage presentation. We'll leave it at one segment today, and we'll push the Iron Condors. All right, let's get to some of these. I noticed this one actually before I went running, and I was really quite scared that I again got the time wrong. My brain is always scrambled because I'm bouncing around between, I'm living in Dubai. My wife is currently right now in Taiwan. We live about half the year in Taiwan. So she's coming next week, which will be awesome. We're doing this massive long, 2-month-long vacation together. We're going to 7 different countries starting basically next week. And it's going to be awesome. I'm going to tell people about it, and you guys can give me suggestions on if you've been to these little cities or countries, then you can tell us what to do. But that'll be cool. But I'm on 2 different time zones there. And then, of course, everything that we trade in the VTS community is all U.S. markets. So I have to think, okay, well, I'm sitting in Dubai. The U.S. markets is on Eastern time in New York, and sometimes I get mixed up. So you kind of freaked me out there. I actually think you might have changed this when I was out on my run, because originally I think it said 8 o'clock or 6 o'clock or something, and I was like, oh, did I do that again? But I think we got it right. I think we nailed it. Okay, my heart's still pumping because I was out running. Like I said, like 15 kilometers is what I typically do, kind of every 2 days-ish on my runs, but 15 kilometers in 38-degree humid weather under the sun is a different proposition than what I usually do. I wait till sunset, which is about 7. I send my email out here around 6:45, and then as soon as I hit send, I take the trades, whatever, if there are any trades to take, I grab the shoes and I'm out the door at 7. So at least without the beating sun, it's a little better. Still 35 degrees at night and getting much worse in the summer, but yeah, today was brutal. You can probably see it. I think I'm actually sweating a little bit, but okay, here we go. Do you plan to put back the performance of every one of your strategies separately as you were doing on your website in 2022? Good question. And before, with performance of every month and every year in a table. I see something else here. Is it connected? As a subscriber of your excellent service, thank you for the compliment. I appreciate to have the performance of each of your strategies and not only all of them together like today. So this is a great question. And essentially all it comes down to is just the feasibility of me managing the business, to be perfectly honest. So I don't know how long you've been watching, but a few years ago, it got to the point where my email inbox was just totally overwhelming. It was 5 to 6 hours a day, and I was just not putting out any new content. You can go back on the YouTube channel and you can see that from about 2017 to 2020, I was actually pretty consistent with the content. And then there was about a 2-year gap there where it was very sporadic. And essentially what was happening is I'm a one-man show here, and I just got overwhelmed with the email. That's also the reason why we shut down the option service, to be honest, too, is that I just didn't have time. I had to decide between VTS, emails, and VTS options. I can only do 2 of those at the same time. I can't do 3. So if I wanted to shut down the emails, I could have told everybody, look, I'm managing 2 separate communities here. I cannot answer any more emails. But then that's not really good customer service, is it? Somebody's paying me money for a subscription, and I'm telling them that I'm not going to answer their questions. So what I decided to do at the time was shut down the option service. And, not for nothing, I don't talk about money very often, but it was on its own making, almost $250,000 a year, and it's been closed for 2 years. So I gave up about $500,000 in the desire to answer people's emails, to basically provide a better service for the VTS and forego $500,000 is not a small amount of money. So I don't know if I don't know if I get any credit for that, but I don't know too many people who would have made the decision that I made that, look, people joined VTS originally, they deserve to get their emails answered. I have to shut down the option service. But I also had to figure out a way to not have 5 hours of emails every day. So I basically made a list of 4 or 5 things where I'm just getting a billion questions, the same question over and over every day by 10 different people. I have to start bottlenecking all that and figure out what's going on. And one of the things that I did, among many, I did several things like starting live streams. That was a good idea. Several things. But one of them is I stopped showing complexity on the website. The website used to be way more complex. I used to show all the performance breakdowns, even beyond the monthly results. I used to show charts and graphs and drawdowns and compared everything. And that was one of the things that got eliminated, unfortunately. Now, very few people have said anything, but I can completely understand. Where did you say it? Your second question. You said you are one of the people that appreciates that. So to you, I apologize. I understand there's going to be a small percentage of people who really do like to dive into the numbers like that, but it just gets to the point where I have to make a decision. Do I want to just service 100% and not do any new content? Or do I want to push things forward and keep adding value to people, right? These live streams are one of the ways that I can A, get more content out there, and B, reduce my email burden, right? I'm going to go through all of these questions today, and that means that not only you're not going to ask the same question again, but if anybody heard the answer, they're not going to ask it either. So unfortunately, this is just a casualty of being a one-man show at VTS. I just don't have the time. I've already sacrificed an entire business. Like I said, it was making quite a bit of money. VTS is way better, but it was making a decent chunk of change. I don't mean to make things about money, but of course I'm not going to work 10 hours a day for free. So there it is. I did the best I could. Canceled one service, focus on answering everybody's email when it comes in. But I do have to simplify the website so it's not prodding all of these questions. I simplified the email as well. I don't know if you've noticed that, but our email, even though some people might look at this, it's actually quite simple right now. You just portfolio, you get a snapshot of the trades. If there's no trades and there's nothing in here, if you don't like to read my stuff or watch my videos, you can just stop right there. And you don't have to just wait for the next day. If you like to look at everything, even if there's no new trades, here's the trade signals. It's organized. I've got a blog. Sometimes there's a clip or a short course library link, and then the volatility dashboard, which again, you don't have to look at this. This is just value added for the people that like to trade on their own. We've got all of our beta stuff. We've got all of our crush levels for all the volatility products. All of these, you can track those. But this is much simplified compared to where it used to be. It used to be a much more complex email. And I simplified everything. And I still answer a couple hours of emails a day, but it is way better, which is why I can now start diving into new content. So to you, my friend, I do apologize. You can always email me and ask me a specific question, and I'll show you any performance you want. But there's just something about having it on the website. This is why I'm always on the live stream. Sometimes I have to actually punt on some questions. If I open the floodgates, for some reason, it just pours in. So I have to be very careful. And it's something that I would never know unless I actually try it. When I did that, I didn't know it was going to work or not. To my surprise, people just stopped asking all those little minutia questions. I don't mean to belittle the questions, but people used to ask, hey, this strategy made 3.45% this month, and this one made 2.5, and how come when you add them up, it's not quite the same? And I have to go through and say, well, it's because the allocation changed from this month to that. It's crazy. It was a whole thing. So things are good now. Things are easier to manage, and I really like where we're at. So email me directly and ask me those questions. But anybody else, I do apologize if you would like complexity. Yeah, things are a little bit simpler these days. Okay, why did the VIX Strangle index, VSTG, not move for 7 years? And since 2022, it's going up in a straight line. If it's because of volatility premium, I haven't looked at it in ages. Sometimes I keep an eye on the Iron Condor Index. That's one of them that I used to track a lot. And kind of the same thing. It was doing extremely well until about 2007-ish, 2008, total flatline. I don't know. I think it's just a function of more, like, as I always say, the options market's pretty efficient. And these types of things that function on a set methodology should not work for long periods of time. You should not be able to say, okay, I'm just going to sell a Iron Condor, 20 deltas either way on a 50-day calendar schedule. I'm going to close it when it's 15 days left, and there it is, there's profit. There should be 0% expectation of profit there because you've not done anything. You've not added any edge to anything. You are quite simply trading options on a calendar schedule. It would be like selling, or buying in this case, buying a VXX or UVXY put option every Friday and then closing it out or just letting it expire the following Friday. Knowing that the volatility products decay over time, you'd think, oh, well, this should make money most of the time, right? Well, no, the options market's efficient. People understand that it goes down. As I always say, everybody and their dog knows it goes down. So there's no edge there. You have to actually apply your edge. You have to know when to get in. You have to know when to sit on your hands and do nothing. You have to know when should it be a 20 delta? When should it be an at the money? When should, you have to actually do something to make money in the market. So without, sight unseen, I have not looked in ages. You're saying that since 2022, it's doing well. I'll look into that. Why would that be? I don't know. Could it be that they switched the methodology? Maybe they're doing something with all this zero DTE stuff. I don't know. That's a good one. I'll look into that. I'll also check the Iron Condor Index because I haven't looked at that in a while either. But again, short term, you can always find little opportunities, and there's going to be some things do really well for a short period of time. But long term, you need to actually apply some edges. You can't simply just, I'm going to do this set thing as a mandate and somehow money's just going to fall from the sky. It doesn't work that way. Okay, I would imagine this is the same answer as we just went through. Where does SVXY get its 0.5 leverage from? What does that mean? It just, the index that it tracks is just tracking half the movement of the VIX futures that they hold. So it's like I said, the MPIT index, that's where it's getting it. Maybe I'm missing something. Why does 2 times SVXY perform much better? That's a good one. I'll add that for a live stream. I like that. 13.6. I don't know. We can try to confirm that. Yeah, that would be interesting. Let's do that. Give me some time to prepare that. So we'll do SVXY versus 2 times SVXY versus 1 times SVIX versus short VXX versus, let's compare a bunch of them and let's actually try to unpack why this is all happening. Here's a good one. Coming to Dubai, July. Very exciting. Well, exciting. It's a great place. July is hot. It is very hot. So I hope that you are okay with that. I'm fine with it. I still go running in the summertime. Like I said, I go at sunset, but I still just do my normal schedule. I even golf in the daytime in the summer. So people look at me like I'm crazy. The cart guy, the marshal guy, because I'm the only one on the course. It's still open, but I'm the only one there. They probably come around about 7 or 8 times during my round and tell me to drink water. It's actually pretty funny. But July's going to be hot. July. When am I going to be here? I'll still be here we get back from our trip July 10th or something, and I'm going back to Taiwan July 26th. So there's about a 2-week window there. Give me a call. Maybe we'll meet up at Starbucks. Did you see the latest research study about the relationship between SPX and VIX futures, chicken and egg? Somebody sent this to me. I've bookmarked it. I will give it a look. Interesting. It's a pretty short research paper, so I can probably get through it pretty fast. Now that you brought it up, or maybe you're the same person. That reminds me, actually, this is something that you guys can do just as a personal favor. And of course, feel free to just not do this. But because I know what your sign up is when you officially sign up for VTS, I know what your email is. I also know what the name says when you email me a question. But because on YouTube, some people use these names that I don't know what they are, again, if you're comfortable with this, just let me know who's who, right? Let me know that I'm this person and I'm also, you probably know me as such and such. But again, don't dox yourself. Just don't really reveal personal information. Don't give me your address or anything, even though I have it on my end, on my PayPal sign up. I won't share it with anyone, don't worry. Yeah, go ahead and do that for me if you'd be so kind. Because I know that I'm probably answering questions from people not understanding that we talk a lot in emails, and it's like, I've been talking to you for years. I just sometimes can't match up these names. So sometimes people use weird usernames on YouTube. You're a trend follower. Why don't you use trend following ETF like DBMF for your portfolio? Well, I like to be my own risk manager. Not to be arrogant, but I know for sure my performance over the last 18 years is far superior to anything else that another manager has put together. So I don't know why I would use somebody else's performance that is much worse than mine when I can, to be honest, I like to think that I present it in a way that is reasonably simple and easy to follow. At the end of the day, it is only an allocation here, here, here. We aren't in that many trades, and we don't trade very often. But inside each of these strategies that, of course, I don't share, right? It just spits out an answer, and you just basically say, buy the SVXY. There's a lot of complexity underneath each one of these strategies. So the answer to your question is, the way that I put my portfolio together, boy, I would bet an awful lot of money that my performance is far superior to anything else that you can find. I'd love to be proven wrong, though, right? If you can find me something, a prepackaged ETF somewhere that is even remotely good, I'd love to get a link for it. I'll check it out. To date, I have not seen anything that would convince me to move my capital out of my own strategies and put them in anybody else's. So I'm my own risk manager. I'm my own strategist. I know why I'm doing the things I'm doing. I don't know why this person's doing what they're doing, right? There's a management team behind this. I don't know about their decisions. This is why I don't use any of the dynamic volatility products. They always say, well, here's what we're going to do. Like SVOL, for example, we're going to be 0.2, 0.3 times the long VIX futures, but we're going to have a VIX hedging component. Great, you do you, but I'm positive my volatility strategy is far superior, so why would I ever even consider using something like SVOL, besides the fact that it's kind of garbage? But you get my point. Like, performance is all that matters at the end of the day, and I've just not seen anything that I would think, oh, wow, that's really great. I'm going to put my capital there. Haven't seen it yet. But again, I'm not saying that I'm the greatest on planet Earth. If you have a link to something that would be intriguing, I would absolutely like you to share it with everyone. And I'll give it an honest, objective look. If it's better, I guess I'm out of a job. But so far, I haven't seen any. Can you remind me why we switch from QLD to VGLT during periods of low volatility? How quickly can I do that? Can I open up? Give me 1 second here. Let's close down this spreadsheet. I'm hoping that the spreadsheet that I open here is not going to crash my computer. As I've said many times, I have so many different spreadsheets at this point, and I try to keep them as simple as possible. But essentially, the reason that we do that is, just mathematically speaking, when the QLD gets into those really low volatility levels, it doesn't actually return any more capital than the underlying bond index does. So I know you're just staring at my dumb face right now, but bear with me. I'm going to see if I have a super simple chart for you already. Here you go. Look at that. On the fly produces. Okay, so what we're looking at here is the VGLT positions in orange and what would happen if we just held on to the QLD through that period. So I guess what I should do is, just because you know what you're talking about, but some people here might not know what you're talking about. There is actually, in this strategy, during super low volatility, we will just cycle right into bonds and just park the cash there. And again, the reason this is happening is because when volatility gets to these really low levels, it doesn't happen very often, but when it does, that might mean that the stock market is kind of running on fumes anyway. It might be looking for a short-term pullback at that point. And you can see, just I'm a numbers guy. I like to crunch numbers. I like to actually test things. You can see this is just not worth it. Even though the terminal results, meaning the long term, if you just let it sit there and you close your eyes and you don't watch it, it's kind of similar, 2%. And this is CAGR, so this is useful. It's only happening on about, here it is, 13.13% of trading days. So it's only happening 13% of the time. But if you can get almost 2% out of that, that's a decent return, right? But look at the drawdown. I mean, this is just insane. And this is what I mean. There are times when just holding the stock market through the lowest of the low, like remember 2016 to 2000, basically right up until a week before the Volpocalypse event, the volatility was extremely low for 18 months straight. Obviously, that performance would have been great, but every other time it would have been bad. So again, I'm a numbers guy. I like to crunch everything. I like to have actual answers. I don't like to just say, well, I feel like maybe bonds would do better than NASDAQ. No, I know for a fact that bonds outperform the NASDAQ during that low vol period. So that's why we do it. Was there anything else? Nope, that's it. Cool. Hopefully that answers it. Feel free to do a follow-up if you want. We're 46 minutes in. What about QID, not QLD? There's a million different leverage products from everybody, like different banks, different issuing banks. There's all these competing assets. And every time I log into the leveraged ETF fund list, it's longer and longer. I mean, it's pages long at this point. So what did I use? I think I was using, because there are others, right? I think, what did I use? PSQ, SDS, SQQ. It's the same thing as the SPXL and the UPRO. They're the same thing. They're just different banks, right? ProShares will have their own version of it, and iPath will have their own version of it. That's essentially all that's happening. So you choose whatever you want. I like, within defensive rotation, 2 times NASDAQ. You can go with whatever you like there. About your wheel of fun strategy, before you use to only sell puts on VXX. That's not true. What has given you the confidence to do a wheel of fun on it? The wheel of fun is a strategy that I introduced, I want to say, first time I wrote about it publicly might have been 2009. And right out of the gate, it was called the Wheel of Fun. Like, I invented that name. That's not the name of, other people won't know what that is. They'll know what a wheel is, but I called it the Wheel of Fun just because I thought, oh, that's kind of a, funny sounding name. So we call it the Wheel of Fun, but it always included the covered call section of it, right? You would never sell put options on VXX, something that's going down. That's actually not the most profitable part of the strategy. It's fine. You can still make it work because we're doing a little bit out of the money. We're not doing it when there's a high risk of massive volatility crush. We're waiting until there's already been a little bit of decay, and then we're jumping in. Like right now, you could do one for next week, for example, because we've already seen a little bit of volatility decay. You could go ahead and sell out of the money put now. But when you really get your money and your payoff is when you just barely get assigned one of those shares, and then you sell a really aggressive covered call at the money, or sometimes even a little bit in the money. Then you get a big payout on the way out the door. So it was always that. I don't know, perhaps because, the way that I present things, sometimes I might have done a live stream where it just so happened that I didn't mention the second part. I don't know, but it's always been the Wheel of Fun, which again, don't be saying that out to everybody else. They don't know what you're talking about. The wheel, they'll know, but no, not true. It's always been both. And I would say it's actually the covered calls that make a little bit more money. Okay, I think you got 3 questions here. I'm a subscriber, but yet to deploy capital. How would I administer capital to a VXX Wheel of Fun strategy when I'm following your portfolio recommendations? Would it be an overlay? Well, it's not even in the portfolio. This is something that is part of what we used to call VTS options, but I had to shut that down because I got too busy with emails. So VTS options is no longer a thing. It hasn't been for 2 years. So the Wheel of Fun, you've probably seen some live streams where we were talking about that, but that's just a remnant of something that we used to talk about a lot that we don't so much anymore. So I would be hesitant to even really bring it up with you, to be honest, because I have not given out direct trade signals for that strategy in about 2 years. I will. There will be a course coming, but as of now, I don't even want to talk about it because there's no signals coming to you. It's just, you could piece it together, but I think even that would be dangerous. What I would recommend, you wait for the full course and then just do it then. For some of your strategies in the portfolio that put cash into the bond ETF, SHV, can I use all that cash for the VXX Wheel of Fun? So you like the strategy, which is good, but I don't know. Like, I don't know your level of expertise. If you're a very experienced trader, I'm not going to sit here and pretend like the Wheel of Fun is some super advanced strategy. It's actually just my personal take on flipping the wheel upside down. Essentially, most people trade a wheel strategy on stocks. And the general selling point for the people on Twitter running their services, they will tell you, well, I'm selling put options on something that I would own anyway, so I'm just getting paid to own the stock if I happen to get assigned. And then I'm going to sell covered calls on something that I already own, so I might as well collect some rent or however they do their marketing thing. Well, that directional exposure is exactly the same as my portfolio. It's exactly the same as 99% of investor portfolios. It's net long equities. If you're doing a wheel strategy on a stock, on Apple, on Google, you are just leveraging your portfolio. That's all you're doing. You're just adding another additional layer of, well, I'm already long the stock market, let's go further long. Because when you sell a put option on something like Apple or the S&P 500, you're not reducing your downside risk. I mean, you are by the tiny premium you collect, but if that thing crashes, you're in a lot of trouble. So what I do is I actually flip it around and I actually say, well, no, the reason that the Wheel of Fun works so well on something like VXX is because I've got plenty of net long equities, net short volatility exposure. I don't need more of that. I don't need to do the wheel strategy on a stock or an ETF. That adds nothing to my portfolio. And I would say that adds nothing to anybody's portfolio. Why would that be a benefit for somebody's portfolio? They're already got plenty of stocks and indexes and all these things that are correlated to the stocks going up. That's fine. What we need is to add a few things to the portfolio that might make a little bit of bonus money when the stock market isn't fully cooperating, right? So let's flip it upside down and do a wheel on something with a decaying product. That's why it's such a powerful strategy. It's a perfect fit for somebody who already has, in my case, 75% of my portfolio is correlated to net long equities. Why would I need any more of that? But flipping it over and doing it on the VXX, now I've really got something, right? And I can use it as a full overlay, not using any margin at all, which is even more powerful because now I can allocate 100% of my portfolio and I can do a 20% overlay with VXX put options that my portfolio and the puts can't both lose money at the same time. It's impossible. That's why it's so good. So there's a whole bunch to unpack there. I would definitely recommend you just wait for the course. Like I said, unless you're an advanced trader and you understand everything I just said, it's not overly complicated once you understand it. But yeah, there's a lot of things I need to unpack before I'd be comfortable telling you to do this with live capital. Okay. George, SVXY and SVIX track different indexes. One is, there you go. You're way ahead of me. Yeah. They track different indexes, but these days you can largely consider them the same. The only way that the short vol index will still be better than the other ones is if the volatility environment itself, if the volatility ETPs did start getting like $5, $7, $8 billion of total AUM, then at that point I would still say the short vol, long vol are better. But right now where the AUM is and where the VIX futures are compared to the volume of the volatility ETPs and the daily rebalancing, I would say that they are structurally identical. I mean, practically identical, not structurally, practically identical. So no danger anymore to holding, like something like the Volpocalypse event that happened. A lot of that happened only because of the structural problems in the VIX futures market. That didn't happen to the short vol index. That wouldn't happen again with the current level of AUM. That Volpocalypse event was largely, it wasn't a pure volatility move. It was largely just an overwhelming amount of daily rebalancing in a very short window of time that caused a liquidity spike that just went out of control. Because a lot of people think, again, well, shouldn't that balance out? Shouldn't the long funds, they're buying futures and the short funds are selling futures? No, they're actually both buying the same futures. When you want to re-leverage the -1 times short and the 2 times long, they're both buying VIX futures to do that, right? So it's just every single volatility product out there that requires daily rebalancing and leverage, they're all buying the same futures and competing for that very small amount. That's what happened. Shortfall didn't do that. And I don't suspect if that repeats itself, it will. Hello to my wife. Excited that she's coming. So she'll be here next week. And little spoiler, little teaser. So we're going to play golf maybe a couple of times here. We haven't golfed in months. I haven't even hit a ball in 4 months. So we're going to play a couple of rounds of golf. And then we're going to go to Amsterdam for several days. And then we're getting on a cruise ship and we're going to do a 21-day cruise in Norway, and it sweeps past Scotland. So we're going to do 5 days in Scotland, 16 days in Norway. Then we're going to get off the boat. We're going to be in Amsterdam for a little while, and then we're going to go to Belgium, 3-4 days there, I think. And then we're going to go to Paris. It's our anniversary, so it's just going to coincide perfectly with my anniversary, 14-year anniversary with my wife. It's going to be a pretty good trip. And then we're coming back to Dubai for another 3 weeks. At that point, we'll probably golf a little bit more and then get back to Taiwan. So in total, I think it's 6 different countries in something like 7 weeks. It's going to be awesome. So looking forward to it. And again, I'm one of the live streams as the date gets closer, I'm going to give the itinerary because I know some of you have been to these cities and you can recommend, hey, you know, you got to go see this castle, or you have to go do, you know, kayaking in the fjords in Norway in this city. You know, people will probably give pretty good recommendations. Again, it's a work trip for me. If I didn't say anything, you probably wouldn't even know I'm going. I will still get my full work schedule in. But it's going to be awesome. Taking my mom as well, so 3 of us are going. Do you think volatility will spike in the coming months, especially with upcoming elections, or if this will continue to be gradual growth till the end of the year? I have no idea, and I really don't like to make those predictions. What I like to do is basically just say, I don't know. Right now, we are in, you know, as you can see, we are in basically net short vol, net long equities. We are aggressively in the market. We are in a couple of iron condors, so you could call these market neutral, and you could call this one slightly negative beta. But yeah, I'm just going to take it day by day. I basically collect my signals every day in the morning, and I treat my portfolio as a 1-day time frame. Even though sometimes we hold the same position for several months in a row, like I'm not going to sell it and then rebuy it in the same instance. I'm going to check the signals every day. Imagine that I'm in cash 100%. What's the best position Monday morning? And then I'll be in that one. Then what's the best position based on all the volatility in the market, based on my entire data landscape that I collect? Tuesday morning. What's the best positions? Wednesday morning. Now, usually it's the same, so we just maintain. But you get the point. I am nimble enough to move in 1 day. So if the market cooperates for 3 months, awesome. We're going to be net long equities. Great. If the market suddenly starts crashing because volatility spiking into the elections, well, we're going to cycle into safety, right? I don't have to make these predictions because I am a systematic quant-based trader, all data related. That's what we're going to do. So if you're asking me what I think is going to happen, I suspect it's going to be a pretty boring summer. I wouldn't be surprised at all if the market is relatively calm for a few months. And then as the election comes closer, especially if you start to get a little bit of uncertain events, like, you know, I don't like to talk about politics, but as it sits right now, it seems pretty obvious that Trump is going to be the next president. So if nothing changes from now until then, there'd be no reason for volatility to spike up. But for example, if they somehow found a way to replace Biden with a different candidate, you might see the market think, oh, wow, we need to rethink everything here. This is totally different now. Maybe there'd be volatility in that case. But right now, yeah, it wouldn't surprise me at all. Again, I'll be ready for anything. I can cycle out into safety in 1 day if I need to. But wouldn't be surprised if it's a very calm, boring summer, to be honest. Time 59:45. I've got 15 seconds to answer 20 questions. Let's see if I can do it. Yeah, we're going to have to cancel some of this. How often do you rebalance different legs of the portfolio? Never. We don't rebalance. Rebalancing happens on its own. So if you imagine what's happening here, I'll just use one of the strategies. When we entered the SVXY, we entered with a 25% allocation on that day when we enter. And we just hold that 25% allocation until the next change of position. So really, there are times, and I'll talk about it in a second when we do a manual override, but essentially we are just going to hold this until otherwise stated. And if it goes up, maybe that 25 would suddenly become 27, 28 of the portfolio. We don't rebalance it. When we finally do move back into gold, I will buy exactly 25% allocation of the GLD gold. And on that day, the portfolio would have been rebalanced on its own. So every time we make a change of position, we rebalance the portfolio. That's what's happening. Same thing here. We're just going to hold the QLD until one of these two things happens. And then on that day, we will buy 25% of the new ETF. And that's how the rebalancing takes place. As far as options go, there is no need to rebalance because these are using a 50% stop loss, 50% stop gain. They're not held open for longer than, say, 20 or 30 days anyway. And then our butterflies are even shorter term. These are only held open for, say, 10 to 20 days, basically. So no rebalancing necessary. Overall, I call it constant portfolio rebalancing. If you go to my YouTube channel and you type in constant portfolio rebalancing, you will actually see a full video talking about that. But yeah, we don't have to manually do anything. Now, there's been times, like last year, for example, we made so much money in the NASDAQ position that we held that I did an override and we actually rebalanced. So I basically just send out a letter saying, well, we're going to bring it back into line with the portfolio. Because we were in it from basically November 1st all the way to, quite recently. Just made a ton. The strategy made 83% or something in 2023. So there are times when it does so well that you have to rebalance. I hope, knock wood, I hope there's never a time that it does so poorly that we have to rebalance, but you get the point. That could also happen. Hasn't yet. Hopefully it never does. But yeah, based on really exceptional performance, possibly there's a manual override, but overall, no need. We're going to have to call this a day. I read that there was a large buyer of VIX calls and VX futures when VIX is near 12. It makes for scary end-of-day returns on sold UVXY puts. Does that affect the overlay strategy? Personally, I don't pay attention to any of this. Even if you could show me that that actually happened, which you're never going to know whether there were other legs of this trade in other, indexes, other underlines. You have no idea, unless you're in the room with this trader or this manager, you don't know if this is a net long or net short position. You have no idea, right? You don't know. Let's say you could even go as far as to prove that this was a standalone trade. Like there was nothing else attached to it that you can't find elsewhere, like S&P put options or something that balances it all out. Let's just say that you knew for a fact that this was the only option trade that took place. You still don't know whether this was just a hedge on a giant net long equities position. That could also be the case, that this is a throwaway. This is not a speculative, boy, I think the VIX is going to spike. This is, I think market's going to do exceptionally well all summer long, but I better throw on some hedges, which is just a tiny percentage of my net long equity exposure on my portfolio. So the point is, unless you're literally in the room with him, it means nothing to any of us. We have no idea what their net exposure is. We don't know what aspect of their portfolio it is, what size it is, if it's a small position, whether they want it to make money, whether it's a throwaway, no idea. So I don't look at all the level 2 stuff. I don't look at, hey, this big VIX trader came through and bought a bunch of VIX calls. I don't care. Maybe VIX trader is the most net long equity portfolio we've ever seen. Maybe all of those VIX options that the famous VIX trader was making, maybe they were all intended to expire worthless. And that was the actual goal of that hedge. If those expire worthless, the rest of the portfolio might have done very well. Or it could be the opposite. Maybe this person is really speculating on these massive volatility spikes. Who knows? Who cares? Don't mean to belittle your question, but again, unless you're drinking scotch and smoking cigars with that portfolio manager, I would ignore it personally. It almost seems like the Fed is artificially keeping the markets stable. I would replace almost seems with definitely is. And then I agree with your question. I mean, that's their job, right? That's what they're trying to do. There's really no secret that the elites are the puppet masters trying to keep everything going in the right direction for as long as possible. And again, unless we're in that smoky, dark, dusty library where they're all the Democrats and Republicans and Trump and Hillary Clinton are having drinks together in the same room, planning everything together. I'm the type of person that thinks they're all on the same team, right? They're just manipulating everything. Jerome Powell is having scotch with Mitch McConnell and Chuck Schumer, and they're all best friends. It's all the big game. They all know the deal. We're supposed to do this, and we're supposed to fight you on this, and we'll throw you a little bone here, but you got to give us something over here, and come on. Yes, it definitely is like the Fed is artificially keeping the market stable. That is 100% true. But even though markets are manipulated, you could say, even though markets and the elites of the world are playing puppet master, we still have to trade the markets in front of us. We have no choice. We still have to do that. Will VTS? Yeah, VIX options, VTS options will come back this year. I've got a handle on the emails. As long as I keep things simple, as long as I keep the email simple, as long as I keep the website simple, as long as I keep doing live streams and answering all these questions live, it's basically a snowball effect where more and more people are hearing the answers to their questions. You ask a question, guarantee you 100 other people have the same question. This is helping me. So I like to do these live streams. This is very helpful for our community that you come and you ask your questions. And also, I will say, start asking more questions in my videos, right? I find like my videos get almost no questions, which is weird because that's a great time to ask questions. And again, all very helpful for the community. Great idea, a VTS ETF. Whose idea was that? I've thought about it, but the problem is it costs about $250,000 to manage an ETF, just basic break even. And even though I am a fully, how would I say this, certified, not registered, fully certified portfolio manager in Canada, like I have all the certifications that you would need to start my own RIA, I don't have a client base there because I do everything through subscription, so it's a global thing. I can, RIA in Canada, I can only manage money for other Canadians. And typically it's in your jurisdiction, so only people in Vancouver. I just decide to do this my way so I can have subscribers from all over the world. But the downside to that is I don't have any startup capital for the ETF. So it would be kind of rolling the dice there. Like how quickly could I get roughly break even? You're talking about 25 million AUM. How quickly would that happen? I don't know. I suspect we're managing like many multiples of that already right now, but there's a risk there. There's an upfront cost. I'm not ready quite yet, but it is an option. It is something that I could consider doing. Do you have $250,000 you want to subsidize? Okay, this might be the last question. Regarding the buyer of sold UVXY puts at 12 VIX question, it seems to happen around power hour. The situation doesn't seem as dire by the next day. Yeah, again, I mean, I get what you're saying, and I understand what you're saying. And it's especially telling when it's large chunks of capital on a relatively consistent basis. You think, well, does this person know more than me? Does this person know something about the market that I don't? Without sounding too arrogant, and this is going to sound terrible when I can hear it in my head. It sounds terrible. I haven't even said it yet, but there is nobody that I would trust more than myself. However that sounds, even if I knew exactly what this person was doing, just the type of person I am, just knowing how hard I've worked for 18 years, I've studied every angle that I can possibly think of, and I'll outwork anybody. Why would I trust anybody else over myself? I am, with regards to my portfolio and what my capital is going to do, I am the authority. I don't need to look at, oh, gee, look at that guy. He's doing this big vertical call on this. I wonder what he knows. I wonder what his portfolio, maybe I should follow him. No, I would never do that. I am the authority on everything to do with my capital. I don't care what other people do. I will just assume they're wrong. Or at the very least, they don't know as much as I do about the trades that I am taking. They probably know more about their style of investing, but that's not my style of investing. Mine works, and it works very well, and I'm the leading authority on this style. So I get what you're saying. Sometimes it's curious when you see big block trades going off, especially like you're saying, there seems to be some patterns and consistency to it. Who cares? Why are they better than you? Scott, you know. Why are you assuming that other person has knowledge that would be helpful for you? You know better than they do. That's the best attitude I think to take. If it's true, I mean, obviously do the work. I know how much work I've done, so I can say that with confidence, even though it sounds terrible to say out loud. It is the truth. I don't trust anybody more than I trust myself. It's very, very difficult for me to accept that there's somebody who knows where my capital should be more than me. It just wouldn't make much sense to me. Okay, I mean, there's too many questions. So unfortunately, we're going to have to cut this because I do like to keep it at 1 hour. But like I said, there's a couple of ideas I have for some spin-off live streams to this topic. So maybe we'll do one relatively soon. But thank you, everybody, for the questions. I love the questions. They help a ton. Everybody who comes and shows up and gives the video a like for me and then asks a question, you are helping so much more than you can imagine. It's just, there's a lot of people out there who they want to ask something, but they just don't, right? Getting back to school when we were kids, there's just something about people, they're wondering things, but they don't ask. So thank you for everything that you did. I'm not awesome with gratitude, but you are much appreciated. Thank you very much, and we will see you in the next live stream.